but a good deal of time has passed. So I think there's a lot of information to cover and a lot of different potential scenarios that have sort of presented themselves within the last month or two. I want to start with the DXY and just talk about the bond market broadly. If you guys are following the Federal Reserve, you know that the Fed has basically been engaged in a tightening cycle for the better part of a year. And the dollar actually followed a parabolic advance, roughly, the majority of that tightening cycle, but has since blown off that parabolic advance and is now sort of, entering the type of market conditions that you generally see after a parabolic blow-off. Now, this is the chart of the DXY. It's the chart measured against, it's basically the dollar measured against the euro and the yen primarily, but also a basket of other G7 country currencies, but the euro and the yen being the biggest two. And you can see that it's sort of blown off this parabolic advance down from here at June 2021 and found this support right here and sort of, created a series of lower highs on the daily as well as the weekly, following that parabolic blow-off. And it's sort of reminiscent of the parabolic blow-off you see in Bitcoin. So here we've got the Bitcoin 2017 run-up right here. And if we put a curve on the chart, a parabolic advance, you can kind of see that Bitcoin blew off its parabolic advance, and then you have a series of lower highs off support that was found around the 6,000 level, and then you have the capitulation here, which marks the ultimate low. And we can mark the trend line right here, mark something like this, and put a price target here. So if we go back to the dollar currency index, you can see that like a similar type of setup is forming here, very reminiscent. And while, obviously there's a lot of different fundamental factors that could go different ways, right? Like the Federal Reserve could ease or they could tighten from this point, and that would certainly affect the way that the dollar price moves relative to other currencies. But this is just a price pattern that tends to play out after parabolics blow off. This pattern we saw on Bitcoin. So yeah, it's obviously not a guarantee, but it is something to watch out for and something to keep in mind. And I do think it lines up with one of the other scenarios I've been looking at in the market. So if we go to equities and just talk about equities briefly, pull everything off the chart. I'm extremely bullish on equities. I think that equity markets have entered what's called the Goldilocks phase, where you have, if you've been following the market at all, you know that like at these levels here, people basically from these lows here, June 2022, which is the same time in the market where Bitcoin found its ultimate low, that basically since that point, that was roughly a year ago, people have spent hundreds of hours, maybe even thousands of hours consuming bearish content, watching podcasts with flames in the background, hearing, worst case possible scenarios. And it's, sort of motivated by the fact that, sentiment is pointing a different direction. People are moved by the tape, and people generally follow momentum. That's why people end up, being most bearish at the bottoms and most bullish at the tops. Well, you can see if you started reading about the worst possible case scenarios here, the market moves immediately against you. That maybe you caught this move, but for the most part, that was not a good place to be getting bearish because the market started moving the other way. And I think, we've sort of been the equity markets have sort of been climbing the wall of worry, right? You sort of have a market when it bottoms out, then you have this sort of slow period where price just kind of grinds against resistance. And every time you have a down candle, then everybody, they fire up their doom porn and, their bearish narratives. But then price just slowly grinds upward. But eventually that phase ends and you enter, what what is considered to be the melt up phase. And I think, we're sort of getting to that point. We broke market structure here, right? So even if you're looking at this as a technical trader, right? I mean, actually you actually had higher highs here. But if you went to a monthly chart, you could see that on the monthly. You took out this monthly high. I think this is kind of the phase in the market where, obviously people who were entering short positions down here are in trouble if they haven't been managing risk. But, even like portfolio managers who are long only portfolio managers, they're sort of getting into trouble too, right? Because the year is almost over. If they haven't been positioned for this move, they're sort of getting into the situation where if they want to meet their performance benchmarks for fund management, and the market is going to continue going, there's starting to be some pressure on them to increase their allocation to the equity markets. And that's really the thing that can, serve as a catalyst for a beginning of a melt up. It certainly would put a lot of pressure on people who are positioned bearishly, force them out of their positions. So you have a combination of bearish capitulation, fund managers increasing their allocation. And the other catalyst is really kind of ties back into the bond market and relates to interest rate expectations for the Fed. So if you guys, I don't have the data on my chart right now, but if you guys were following, the Federal Reserve, FOMC, that, the Fed has been pretty steadfast in fighting inflation for the last year. But more recently in the Fed June FOMC meeting, they actually paused interest rates. So, CPI is coming down pretty dramatically. So, you had CPI roughly at, peaking last year at 9%, and it's fallen down to 4%, and, forecasts have it at 3% next month, and then down into 2% later in the summer, around August and September. So you see this like pretty steadily clear and consistent trend in CPI going down after the peak in last year. And that's sort of the basis for the Fed increasing their interest rate hike policy. So, at the June meeting, they basically, June FOMC meeting, the Fed paused rates, but then indicated that, inflation is not where they want it to be. And there still could be, even though they've paused, there still could be future potential rate hike increases. So that's them sort of, trying to manage what, in my opinion, the stock market, right? They're not, in my opinion, I think one of the big mistakes the Fed is making is not focusing on credit markets, because they've already over tightened in credit markets, and the lag effects of that tightening is still to be felt. But they're sort of leaving interest rate hikes on the table for the future because the equity markets have been rallying. But I think, what they've essentially done is they've essentially created a set of bearish expectations on top of what could be a parabolic, the base of a parabolic rally. So expectations can either be met or unmet. So if you create a set of bearish expectations, that generally ends up being bullish if they're not met. And the way that they would not be met is if CPI continues to fall pretty dramatically over the summer. It's at 4% right now, so you get a decline into 3% by the July FOMC meeting. By the Jackson Hole meeting for the Fed in August, say it's down to 2%. Then when you have CPI that's back at their 2% target, then you may have a Fed that comes out and say, okay, even though we still had, a few months ago we had interest rate hikes still on the table. Now we don't, we're taking those off the table, and we're just going to pause and hold here. And I think when if that scenario were to occur, I think that would be the catalyst for, a major melt up in equity markets. And remember, CPI is falling it's falling dramatically now, and it's gaining speed as it falls. So this would happen very quickly. It would happen probably within the entire duration of the next quarter. So we had the markets bottom out, and this was Q2 2022. So this was your bottom right here. And then Q3 was the first up candle of 2022. Then you had continuation in Q1 2023. And now we have this candle, this quarterly candle, which represents Q2 2023. And that's going to close in a day and in 8 hours. So we'll get that quarterly close, before the holiday weekend this weekend. And then we'll get the start of Q3, which I think could potentially, we'll see that acceleration in CPI occur during Q3 2023. And if those scenarios play out, that could be a very explosive quarter. And again, this is assuming that those conditions, are in effect. But I think if we do see that CPI, fall very quickly, and remember, CPI is it's a year-over-year change now with the new metrics. So because CPI peaked in June of last year, and now we're in June right now, as we move into July and August and September, it's starting to discount the peak, right? Because June 2022 was the peak. Once we're in July, it's only year-over-year change, so it's no longer factoring that peak data into the CPI calculation. And, July 2022 is just a little bit below June 2022. When we get to August of this year, 2023, it'll no longer factor that. So you can see how it's like, it's not an objective measurement, but it's a rate of change measurement, which is why you could actually have CPI go negative in a deflationary situation, with bank crises and bank explosions. I'm not predicting that, but it actually is a possibility that people, just really aren't considering. But again, I don't think that my base case is that CPI continues to decline until that 2% target that the Fed has sort of laid out for itself sometime in Q3 of this year. And the Fed takes a victory lap and, declares that there are no more rate hikes on the table. And assuming those conditions are met, then I think Q3 is very, very big in the equity markets. And I'd be looking for a melt up, looking for new highs in SPY. And I think, where the people are not going to agree with me here is I think, if SPY takes out the previous highs, I think, things start to move very, very parabolically. You sort of have like a vertical market after that, where, S&P 500 can move from like 48, 480 up to, 600, up to 650 very quickly in a very parabolic fashion. And, if that happened, you would see all this bearish sentiment right here. Well, not necessarily right here, but all the bearish sentiment that we've seen, if you're on Twitter, if you're on YouTube, sort of flip on its head, right? And once you take out those highs, and if you had that vertical market after new highs, you would see all that bearish sentiment sort of melt away, and you would see people get extremely bullish. And even though the underlying fundamentals don't necessarily change that quickly, you still have a sovereign debt crisis, you still have an energy market crisis, you still have a housing market crisis, you still have like these fundamental things that haven't changed at all and have served as the basis for people's bearish bias. But if price starts going parabolic, people will forget about that. It won't matter. They'll chase price. So I do realize I'm getting a little bit ahead of myself in this, laying out the scenario, but I would want to say that if that scenario unfolds and prices do start going vertical like that, I think that would actually be like a great time to be really cautious, because it's not necessarily like a new paradigm, and all those fundamental issues don't matter. You could have sort of a melt up and then a blow off top, and then, you know, a significant bear market. Something to keep in mind. You know, but with that being said, you know, if you are listening to this channel, you probably trade Bitcoin specifically, and so, you know, while, you know, Bitcoin could break its correlation to equities and move upward, even though equities are, you know, having a crunch. That melt up scenario and bust that I laid out previously, you know, let's go back to the SPY chart. If that were to occur, I personally, because of the way that CPI is accelerating to the downside, I think it would occur in this next quarterly, Q3 quarterly, and then, you know, I wouldn't expect it necessarily to continue on beyond end of year, even into Q4, really. I would just sort of see it as short-term price action. Now, you know, if you're looking at that in the context of Bitcoin, then, you know, you are aware that the Bitcoin halving is pretty close. If we were to put it on a chart, I think it's sometime in April 2023. So let's see. Yeah, there we go. So roughly the start of Q2. We just say Q2 2023. So we'll leave that on the chart. So yeah, that would be, you know, pretty rough. You know, say equity markets do melt up, you could probably see some type of continuation in Bitcoin. Does it make new highs? That's unclear. But in that scenario, you know, say the equity markets start to leave their Goldilocks period in Q4 2023 and, you know, start to decline. Well, you know, you have the Bitcoin halving pretty close up within a quarter of that potential scenario. And, you know, it'd be a weird scenario if you have a Bitcoin halving going into a, you know, an equities bear market. We've never really seen that. You know, we've really only seen, I mean, equities have been in a bull market ever since, you know, quantitative easing began in 2008. So that would be an interesting phenomena. I think in that scenario, you probably would see Bitcoin sort of decouple from its correlation to equities, and Wall Street and fund managers would probably stop treating it like a high beta tech stock and treat it more like they would treat gold, right? Because I think that's the proper way to look at Bitcoin, is treat it as the same way you would have treated gold, you know, in the 80s or the 90s. Now, diving into price action specifically, you know, we've had a lot of, you know, we've had a clear trend shift since the cycle lows down here. You can see, you know, you have this very clear pattern here with breaking above highs here, running down into those highs, and then bouncing off, then entering a period of consolidation after breaking above these highs right here, running down, bouncing off. I mean, this is very clear trending behavior. And, you know, if you are trading a trending market, you want to see this type of behavior, right? You want to see price showing a quick reaction once it runs down into those old highs broken. You want to see it move impulsively off, similar to how you saw it here. You know, if it was a scenario where, you know, price breaks above the highs and then moves down and then like moves into these highs and then moves down into the basic consolidation, hangs out around there, that is, you know, it's signifies a weak trend. So here we're sort of seeing the symbols that, you know, Bitcoin sort of is maintaining that strong trend, but it does, if you are trading this technically, you know, there's a great degree of resistance overhead. I mean, you have, if we just start at the quarterly, you have this quarterly open right here, quarterly low right there, marked by this candle low right there. You have the bodies of these candles right here. But really the area I'm looking at is, this area of interest right here where price consolidated here. You had a throw over above these highs and then it moved impulsively down. And I'm looking for the area in this price action where price started to create inefficiency, right? When it moved explosively, creating these gaps in price action. So, really, you have this area here, the area between this candle high here and this candle body here, which could be considered a gap, although you have a wick here. But you also have an inside gap, which is represented by the distance between the candle bodies here and this area of inefficiency up here. So you could see, price come up, fill this area right here, maybe consolidate or have a little bit of a pullback, and then, run up to these levels. Again, it's not to say that price has to do that, or price has to reach for these levels, but this is just the way I'm looking at the market. This is the way I'm trading it. You certainly could see price stall or retrace a little bit. Again, there are no guarantees in trading, but I think, one clear thing that we've sort of seen recently is Bitcoin market cap dominance is pretty strong. And, while I do think, at some point this will be a good opportunity to, accumulate altcoins, and I actually personally have used it as an opportunity to accumulate Ethereum, build an Ethereum position, and will at some point, get into altcoin plays and play those. I don't necessarily, I don't feel comfortable calling the top on that just yet. I think, really we saw a catalyst roughly a week ago with the, BlackRock announcing a spot Bitcoin ETF, Fidelity announcing a spot Bitcoin ETF, announcing Coinbase as their custodian. They weren't announcing a spot Ethereum ETF, right? It's a spot Bitcoin ETF. So I think, those type of trends in the market, they don't only last a week. Those trends tend to last a quarter. So I think, you may see Bitcoin dominance, hold strong for a period of a few months. But then, after that point, that's when you start to see people, if that were to happen, then you would have people coming out and, say all altcoins are going to zero. Only Bitcoin will be, it's only Bitcoin from here. And again, of course that's a point in the market where you probably want to be accumulating altcoins and where you really have the best opportunity to make an altcoin play. But sort of getting back to that theory with SPY, SPY potential melt up scenario, what would happen with the dollar currency index? Well, I think, if that were to happen sometime in Q3, let's go to Q3 here. I think that would kind of, if you had a melt up in equities, that's sort of when you would probably see the dollar, if it were to play out this pattern to finally played out and have this like final capitulation low here down to, either the, I'm sure there'd be a few bounces along the way, but, probably 97 region, 95 region, at least initially. And, if you were to see that explosive movement in the dollar lower, of course, then you would really see people come out. I mean, you've already seen people come out and say, the world is de-dollarizing, people are, the BRICS countries are moving to a basket of currencies backed by oil and gold. I mean, you would really hear that talk kind of accelerate if, you would see a capitulation type pattern in the dollar. But that would probably ultimately be a local low in the dollar. And you'd probably see, bottom off there, probably retest some resistance. And that would probably also mark roughly a top in both Bitcoin and equity markets at that point. And again, I'm looking, I hate making predictions, but if that scenario were to unfold, I would be looking for that to happen at some point in Q4 or, Q1 of next year. Now, how does this tie into the oil markets? Well, you basically we've got WTI crude oil, which tracks the price of U.S. shale production, which is really critical. When people talk about oil markets, they're generally talking, you'll hear reference to Russia and Saudi Arabia, and rightly so, because they are large producers of oil. But most of the growth in production of the oil sector is actually in West Texas and the shale oil production. And sort of a corollary of that is when the dollar was, spiking and interest rates were spiking, the U.S. government unloaded its the SPDR, or the special reserves of its oil holdings, and took its oil holdings and dumped those on the market. And that was sort of in combination with the rise in interest rates what contributed to a decline in the oil prices. But I think you're sort of in a position now where oil can go lower, but the U.S. government needs to refill its oil reserves. So they've come into the market and announced that they're going to actively buy oil at the 70 mark. So you basically have an unlimited bidder, right? You have a bidder who has access to unlimited amount of dollars. It can print as much money as it wants, who's announced it's going to start bidding at 70. So it's kind of hard to fade that. The other thing you have going is you have both U.S. shale oil production in West Texas being cut dramatically, which is actually, kind of a corollary of what's going on in the credit markets and, credit drying up and that production dying down. But you also have OPEC cutting oil production. That's the Saudi Arabia conglomerate. So you have all these major oil producers, cutting production, which reduces supply in the market. People who are bearish on oil, they say, well, they're cutting production because they know that a recession's coming and that oil prices are going to go much lower. And, I would make the argument that, I don't really see oil demand going down. If anything, I see, with the Ukraine war and, you're seeing conflicts with China and Taiwan, you're seeing like a militarization of the entire world, right? You're seeing global orders fragment, and you're seeing this like geopolitical balkanization of different forces, which will be compounded by stress in the energy markets, which will force people to break ranks and to make new allegiances that people didn't expect. And by that I mean like trade with Russia. If the only person who's not cutting their oil production is Russia, America and the Middle East are cutting their production. So that sort of encourages people to side with Russia, cause these geopolitical fractures, which, encourages war, right? And you mix that with the sovereign debt crisis. Like you can see how like entities that were once stable, like the European Union, might fracture and, break off. And for countries that are self-sufficient, that's not a big deal. Like they can just break off from whatever political organization they're a member of currently. But if they're not as sufficient, if you're a landlocked country that doesn't have a lot of natural resources, no ports to trade with other countries, like you don't have a lot of natural endowments as a country, and you previously benefited from your membership in this political organization, and suddenly that political organization dissolves, and now you're not self-sufficient. Like that is really the type of thing that can lead to war, right? As countries invade other countries to force them to trade with them, right? So you're seeing this like balkanization of the world broadly, and militaries consume an incredible amount of oil, right? It's a huge demand on oil production. So you know, there's an old saying that energy demand is relatively inelastic, right? You demand for energy, you still got to ship goods, people got to get to work, people, there's a relative inelastic demand for energy, but there can be, surges in demand like militarization and things like that. So it's a long way of saying that I don't really agree with that bearish take that demand for oil is going to go down. I actually see demand going up because of militarization, global conflict, while supply is being cut. And when supply and demand 101, if you cut supply and increase demand, like, prices go up, right? Especially when you have a limitless bidder of the U.S. government trying to refill their special drawing reserves that they depleted to try to directly fight inflation was the purpose of doing that, and I think to some degree they've been successful. But now they're in the business of replenishing that. So it's a long way of saying that oil is it's a very successful hedge against inflation, or at least like if you were to think of it as in medical terms, is like preventative medicine, right? If you can buy oil at cheap prices, you can really hedge yourself against inflation, because oil might as well be a inflation index, right? Because if the cost of oil goes up, that means that the cost of everything goes up, because it takes oil to produce everything and to transport everything and to drive in your car to go buy it after the ship has shipped it. So it's really an index for inflation. And if you're able to buy add oil to your portfolio when prices are low, that's usually optimal. Now, who's to say price can't go lower? But if you just follow me with this logic or line of thinking, when oil goes parabolic, like it did in the Ukraine war, there's certain things that are kind of predictable that will happen. Like the responses from central banks are pretty predictable. So if you own an oil allocation in a portfolio and it starts going parabolic, like, you can kind of expect central banks to take specific actions, that being, raising interest rates, tightening financial conditions, because they know that when oil goes parabolic, that they're going to have to deal with inflation. So they got to get ahead of it. And it's a long way of saying that, if you have that long oil position and it starts going parabolic in your favor, it's not really a great time to add to that position, because it's actually time to start selling that oil into cash, because that as oil is going parabolic, central banks will probably tighten financial conditions and create the type of environment that is beneficial to holding cash. Anyway, I hope you guys like this video. I know it's not really down in the nitty-gritty of price action, but sort of a big picture, quote unquote macro outlook, that I hope you